Yes, welcome to our class today. We are going to look at the ATD Level 3 paper on fundamentals of finance. This is a paper that was done in December 2024. So we are going to look at the questions and trying to come up with the best answers for the questions, and of course explaining the best choices that we choose, and looking deeper into understanding why other options probably are not the right options to choose to take as the right choices. Now, this paper consists of 50 multiple choice questions, and we are going to answer each one by one to determine which is the best alternative. Now, the first question asked, which one of the following best describes the primary goal of investing decision in corporate finance? Which one of the following best describes the primary goal of investment decisions in corporate finance? Now, maximizing short-term liquidity. Is it maximizing short-term liquidity? Is it minimizing financial risks at all costs? Is it maximizing the long-term value of the firm? Is it ensuring equal distribution of profits among stakeholders? Now, to explain this point, when we talk about investment decisions in the corporate finance, we need to understand the organization. What when it comes to management, how is the organization made up of? We can have kind of like a pyramid that categorizes management in organization into three categories. At the topmost, we have the corporate level. Then in the middle, we have the business level. And the lower level, which is the functional level. Now, when you talk about the corporate level, here we are talking about the top management. The top management basically are involved in making strategic decisions that will anchor the organization, the success of organization, that will lead to the success of an organization. Now, when you are talking about strategic decision, most probably they are more concerned about the growth of the organization. They are more concerned about the stability of the organization. We can talk about they're the ones who come up with the decision of like cost cutting. So sometimes when it comes to decisions like retrenchment, so they're involved in that. Then when we talk about the business level, here we are talking about the middle level. Middle management. The middle level of management, where we classify such positions like the line managers, managers who are operating within different, if you have different lines and all that. So the type of decisions that are made here, these are business competing strategies. Those are the type of decisions that they make. Business competing strategies. They will want to come up with strategies that are that are used for competition, either in terms of differentiation, either in terms of cost leadership, in terms of focusing specific markets and all that. So they are coming up with strategies in terms of which strategies can best help us to compete with our competitors in the market. Then, of course, when you talk about the functional level, these are the lower level, or these are the lower management. This is where the functional are from the departments. These are the departments the department's management kind of level strategy. So the department manager, the human resource manager, the finance manager, procurement manager, the IT manager, and all those. So you'll find that these are functional, these are operational strategies that aid the daily operations of the company, running its activities. So they are functional, they help in the functions or the daily functions of the firm. Now, these are mostly kind of short-term. They help the organization to achieve short-term goals and all that. But when you compare it with the top management, which is the corporate level are looking at the long-term survival of the business. So they are making strategies that will help, or that will help the business to achieve specific achievement coming in the long run. Like, for example, we're talking about strategies that are going to affect the company for the next 5 years, 10 years, 15 years, 20 years going forward. Now, when you go back to our question, when we are talking about which of the following describes the primary goal of investment decisions. So investment decisions, we have classified them under corporate level strategies. In corporate finance, under corporate level strategies, these are decisions that are aiding the organization to stabilize. They are focusing more on the growth of the organization and the stability of the organization. Now, when you look at to further explain the investment decisions are corporate finance decisions. The overview of that is that these are more likely to be known as capital budget decisions. It's where the corporate level management decides where to invest its money. So these are decisions that are based in terms of how are we allocating our resources, in which investment are we going to put our money, which is the best alternative compared in terms of what returns it bring forth and all that. So these are core functions of the corporate finance, whereby these decisions involve choosing where and how the company is going to allocate its capital, or what we call money, or many other resources. So these are supposed to help generate the highest possible returns for their shareholders. When it comes to why do the organizations or the corporate finance has to make these investment decisions? The investment decisions are very crucial because they help determine how the firm's capital is going to be allocated, in which projects is the firm going to put in money and resources, what are the returns, and how those returns are going to affect the growth or the stability of the company. So the core goals of the investment decisions include, like, for example, maximizing the shareholder wealth, which is our primary goal. When you talk about maximizing the shareholder wealth, we have explained and said that the ultimate goal of the investment decisions is to increase the long-term value. So they are focusing on the long-term value of the firm for its shareholders. So this means that they select projects of investment that are expected to increase the company's net present value and to contribute positively to its future earnings and market value. And also, if the company consistently makes good investment decisions, it means that the stock price and the market value is likely also to go up or to rise. The second goal for investment decisions is that it helps in efficient allocation of capital. In other words, capital is limited or in most organizations. So it's based on the decision, where are we allocating our capital, where are we putting our money, and what value are we getting from the money that we are put in specific projects. So investment decisions aim to ensure that the funds are used in the most profitable and strategic aligned projects. This helps to avoid wastage when it comes to resource of low return or non-core activities. Also, these decisions help generate future cash flow. That means that investments should lead to stable and growing future cash inflows. So they help in supporting other financial decisions like debt repayments, dividends, reinvestment, and all that. So there must be a very good financial cash flow in the future to facilitate the management of these financial decisions, like deciding how many dividends, how much of the dividends are we going to pay, the value, how much are we going to reinvest, and all that. Also, they help manage and minimize risk. So investment decisions aim to balance the risk and return by selecting the projects that match the company's risk appetite. Also, diversifying investment across different sectors or projects can also reduce the overall business risk. They also help in enhancing competitive advantage. So strategic investment, like for example in technology, research, expansion, and all those, this can help the firm to outperform the competitors and secure probably long-term market share. They help support sustainable growth. In other words, the investment decision should not only target profitability, but also promote sustainable business practices, innovation, and even long-term viability. Also, they align with corporate strategy. In other words, they go in hand in hand with the vision and the mission of the institution. So every investment should contribute to the firm's overall vision and strategic goals, whether it makes expansion, innovation, or operational efficiency. Now, when we talk about these types of investment decisions, we are talking about things like capital budgeting. This is the long-term investment decision, whereby you are choosing between projects such as new product line, factory expansion, technology upgrade, and the likes. So, for you to make these decisions, you need to use tools like calculate the net present value of the projects, calculate the internal rate of return, calculate the payback period, at the same calculate the profitability index to determine which is the best project to invest in. And also, when you're talking about the investment decisions, they help. We are having the working capital decision. These are the short-term investment decisions which help in managing current assets and liabilities like cash, inventory, receivables, and all that, because its intention is to ensure that liquidity and operational efficiency is achieved. So, the best alternative for the question, which of the following is best describes the primary goal of investment decision in corporate finance, is option C, which states that the best goal is to maximize the long-term value of the firm. So we have clearly said that even when we talk about the goals, we said the main goal is to maximize the shareholder wealthy. So the ultimate of investment decision is to increase the long-term value of the firm for its shareholders. So why choosing that option? It's because the primary goal, as we have clearly stated, is that the primary goal of investment decision in corporate finance is to maximize shareholder wealth, which is closely linked to maximize the long-term value of the firm. So investment projects should be evaluated based on whether they increase the company's net present value or long-term profitability. So if you look at why other options are incorrect, for example, option A, short-term liquidity is important for operational and not ultimate, but it's not the ultimate goal. Option B, minimizing financial risks is important, but not at all costs. So some risks is necessary to grow value and stuff like that. And also when you talk about equal distribution of profits amongst stakeholders, it isn't a corporate financial goal. It's more of a social equity concern and not a financial objective. So our right answer is C, which talked about maximizing the long-term value of the firm. Now let's look at question number 2. In the context of dividends, in the context of dividend decisions, which one of the following statement is true? High dividend payout ratio always lead to high security prices. Companies with high growth opportunities generally pay lower dividends. Dividends are irrelevant to the overall value of the firm according to the Modiglian-Miller theorem in perfect market. Dividend decisions have no impact on the company's cost of capital. Now, when you talk about dividend decisions, this refers to the policy in terms of the company uses when it comes to payment of dividends. So, dividends is basically about distribution of the profits earned by a company to its shareholders. And we said that there are two types of dividends. You can have ordinary dividends, which are known as common dividends, or you can have preference dividends. And the preference dividends are given priority. They are paid first, then ordinary dividends are paid after the preference dividends have been paid. Now, when you talk about this, we have said that dividends refers to the company's policy regarding the distribution of the profits to their shareholders in the form of dividends. It is one of the three core financial decisions alongside with investment and also financing decisions made by the corporate level. So the goals of dividend decisions, why dividend decisions have to be made, like in this policy, is for the purpose of maximizing shareholder wealth. And at the same time, it helps to balance between retaining earnings and paying dividends. Also, it helps maintain a stable and predictable dividend policy. And also, it's a signal of financial health to the investors, signaling which can lead them to invest more and more. So, if we are being asked in the context of dividend decision, which of the following statement is true? The true statement is that companies with high growth opportunities generally pay lower dividends. Now, when you talk about high growth opportunities, it means that the company needs to put more money in business for the purpose of growth rather than payment of dividends. So companies with high growth opportunities often need to reinvest their profits to fund expansion, research, and even capital projects. As a result, they tend to pay lower or even sometimes no dividends. Also, they retain earnings for internal financing, and they focus on the long-term value rather than the short-term payout. Like, for example, we have given an example there that tech firms like Amazon or Tesla historically paid little or no dividend because they were reinvesting heavily on growth. So probably the right answer in this is that companies with high growth opportunities, they tend generally to pay lower dividends because they tend to shift the amount into reinvestment for the purpose of growth. Also, if you look at the other options, when the other option states that high dividend payout ratio always lead to high security prices, this is not always true, because while some investors prefer dividends, others prioritize capital gains. Also, high payout ratios can also be seen as lack of reinvestment opportunities, which might hurt long-term growth for the organization. The other option that states that dividends are irrelevant to all overall value of the firm, according to Modiglian-Miller theorem in perfect markets. This partially is true, but under very strict assumptions, like there are no taxes, there are no transaction costs, there's perfect information access to that. So, but in the real world, dividends do matter, because due to taxes, investor preferences, and even information asymmetry, dividends do matter. When it comes to dividend decisions have no impact in the company's cost of capital, that is totally incorrect, because dividend policies can influence the cost of equity and the overall cost of capital, especially if investors interpret dividend cuts or increases as signals about the future earning of risks. Now, question number 3, which one of the following factors is least likely to affect the company's decision between debt financing and equity financing? So debt financing, it means that the company is using borrowed money. This refers to the loans from financial institutions and other bodies. Equity financing, this is raising money through the sale of shares, the company shares, which means that you are giving a part of ownership to other people, and the shares that they buy, the money that they use to buy the shares is what we are talking about, the capital that is coming to the organization. Now, when we are talking about historical security price volatility as the best answer, because the question is asking which one of the following factors is least likely to affect the company's decision between debt financing and equity financing. We have the current interest rates, we have the company's risk tolerance, we have historical security price volatility, expected future cash flow. The right answer is historical security price volatility. Why that? It's because when a company decides how to finance its operations or investments, it typically chooses between debt financing, that is in reference to either loans, bonds, and the likes, and equity financing, which is issuance of shares. So severally, the key factors influence this decision. Like for example, while price volatility reflects the past stock market performance, it does not directly influence whether the firm chooses debt or equity. At the other side, lenders and investors may consider volatility as a risk signal, but it is not the primary factor in the firm's own financing decisions. So a company is more concerned with future projections like earnings, cash flows, and cost of capital than the past market fluctuations. When you look at the other options, we are talking about current interest rates. They do affect the decision. The interest rates directly affect the cost of borrowing. So which means that if the rates are low, debt becomes cheaper. If the the rates are high, then it means that the debt becomes expensive, making it difficult to access the debt financing. So this might lead the organization to decide to use equity financing rather than debt financing, which might be expensive to acquire. The company's risk tolerance. Risk-averse companies may prefer equity to avoid the burden of fixed debt repayment. So more risk-tolerant firms may use leverages debt to amplify the returns and the likes. And when you are talking about the last option, expected future cash flow, debt requires regular interest and principal repayment. So a company must ensure that its future cash flow are sufficient enough to service the debt, making this a critical factor when it comes to the decision whether you are going to use debt financing or equity financing. So the best option is option C, that states that historical security price volatility. Definitely historical security price is the least factor that affects the decision between debt financing and equity financing. Now, question number 4. Which one of the following mechanism, of course, that is what we have answered, sorry. No, question number 4. Which one of the following mechanism is least effective in reducing agents' conflict between shareholders and management? Which one of the following mechanism is least effective in reducing agents' conflicts between shareholders and management? Now, when you talk about the agent conflict between these shareholders and agent management, so this means that an agent conflict arises when the misalignment of interest between the shareholders and the management. Now, when you talk about the principals, these are the owners of the institution, these are the shareholders, and the agents are the management. The management are working for the owners, are working for the shareholders, the owners to grow the business for the in purpose of them or in the interest of the owners. So these are hired to run the company. Managers are hired to run the company on behalf of the shareholders. So although managers are supposed to act in the best interest of shareholders, they may sometimes pursue their own personal goals instead, which means that they are diverting from the objective of the organization, which is in line with the vision in relation to the expectations of the shareholders. So if you look at the common agency conflicts that are there, if I can explain them in point form. The common agency conflicts, for example, we have the empire building. The empire building meaning that managers pursue expansion projects, e.g. like acquisition, new divisions and all that, not for profitability, but to increase their influence and status and justify a higher compensation or more staff. This may lead to inefficiency use of capital, which might not be the objective when it comes to shareholders. The second conflict can arise from perquisite consumption, meaning that managers use company funds for personal luxury or comfort, such as lavish offices, first-class travel, club membership, or private jets and all that, which might be incurring expenses that do not benefit the shareholders at all, while they will be reducing the profits in that organization. The third conflict can arise from short-termism. Now, in this short-termism, meaning that managers focus on short-term earnings to, for example, hit quarterly targets because they're working on target to look at the performance so that the company can be performing well based on the short-term perspective. Also, they can focus on these short-term earnings for the purpose of boosting their bonuses or even stock prices temporarily. So this may sacrifice the long-term investment in research and development, for example, innovation, sustainability, and all that, which might be the core goal of the shareholders. Also, there will be another conflict in terms of lack of effort. Managers may exert minimal effort to avoid hard decisions such as delaying restructures or layoffs, delegating excessively and all that. This leads to reduced productivity and inefficiency, which leads to poor performance against the shareholders' wish. Also, we can have a risk in terms of risk aversion. Managers avoid risk projects even if they have positive expected returns because they fear that they might lose their job if things go wrong. They prefer job security over shareholder returns on this perspective. So this may result into missed opportunities for growth, which might not go well with the shareholders. Also, lastly, in terms of information asymmetry. So managers may withhold the bad news. So the shareholders might not get access to that news for the purpose of decision making. Managers might manipulate financial reports, which means that the financial report cannot be able to reflect the true picture of the financial stability of the organization. Or it can be delay disclosure of poor performance to the shareholders. So this will prevent shareholders from making the informed decision, which in turn weakens the oversight of that organization. Now, so back to the question. Now, when the question asks us which one of the following mechanism is least effective in reducing agents' conflict between the shareholders, performance-based compensation can reduce that effectively. Regular external audit, it can reduce that effectively. Active board oversight, it can do it better. But when you talk about increasing executive salaries, that is the least strategy that can reduce the conflicts. So agents conflicts arise when management does not act on the best interest of the shareholders. So this is known as an agency problem. So companies use various mechanisms to align the interest of managers with those of shareholders. So simply, like for example, simply paying higher salaries without linking them to performance does not motivate better alignment with shareholder interest. It may reduce the cost of sensitivity and encourage complacency, but it can worsen the agent's problems rather than solving them. So a higher fixed salary can create a disconnect between management rewards and even the company's success. So when you're talking about performance-based compensation, this aligns the manager rewards with company performance, e.g. bonuses, stock options. So if you perform better, you will earn bonuses, or you will also buy shares of the company. motivates managers to, this all motivates managers to focus on long-term value creation for shareholders. Because if you're performing better and you're given an option also to buy some shares for the, or you're given some shares as reward for the better performance, it will mean that managers now will focus on ensuring that they are growing the long-term perspective of the company, which means that because they are going to be awarded based on the performance. Regular external audits, this increases transparency and accountability. It helps shareholders monitor the use of company resources and detect mismanagement. Also, active board oversight. A strong independent board can monitor executive decisions and hold them accountable. This ensures that the management acts on the best interest of the shareholders. So the best answer is C, which means that increasing executive salary is the least option or strategy that can solve the problem between the agency management and shareholders. Now, question number 5. Which one of the following is a point of conflict in the agency relationship between shareholders and debenture holders? Now, when you talk about shareholders and debenture holders, shareholders, these are the owners of the company's equity. They benefit from the company profits and share price appreciation. But when you talk about debenture holders, these are lenders or bond holders who have loaned money to the company. They receive fixed interest payment and the principal payment in return. So, if there's a conflict between the debenture holders and the shareholders, what are the common conflicts that are there? The common agents conflicts between shareholders and debenture holders is, for example, risk shifting, that is the asset substitution. So shareholders prefer riskier projects because they benefit from the potential high returns, while debt holders bear most of the downside risks if the project fails. So this can lead to a shareholder pushing management towards riskier investment than debt holders would like. Number 2, we have the underinvestment problem. So when a company is close to default, shareholders may refuse to fund new projects, even if they have positive net present value. So this harms the debt holders because the company's value does not increase and their chances of repayment decreases. Also, we are talking about dividend policy conflicts. Shareholders may demand high dividends to receive immediate returns, whereby high dividend payout reduces the asset availability to repay the debt holders, which increases the default risk in this perspective. The debt covenant violations. Shareholders may encourage management to violate debt covenants to pursue their own interest, which creates a risk for the debt holders who rely on covenants to protect their investments. And of course, when you talk about information asymmetry, debt holders often have less information about risks, business decisions favored by the shareholders. So this increases monitoring cost and uncertainty of the debt holders. So when we have the options in terms of which one of the following is a point of conflict between the agency relationship between shareholders and debenture holders, we have been given options: the level of dividends paid to the shareholders, the risk profile of new investment projects, the timing of executive compensation, the frequency of board meetings. The best option is the risk profile of new investment projects. So why are we choosing this? This is the best answer because debenture holders, who are the creditors, prefer low-risk projects to preserve their interest and the principal payments. So while shareholders may prefer higher risk projects with potentially higher returns, this mismatch in risk appetite is a classic agents conflict between the debt holders and the equity holders. But when you look at the other option, the level of dividends paid to shareholders, While dividends can affect the firm's ability to repay debt, dividend decisions are more directly an issue between the shareholders and management rather than debenture holders. So, however, paying these high dividends could reduce the buffer available to repay the debts, but creating some concern for which will end up creating some concern for the debenture holders, but it's not the primary agency conflict compared to risk-taking behavior. The other option is that the timing of executive compensation. This is a concern primarily in the agency conflict between shareholders and management, not between shareholders and debenture holders. Debenture holders are more focused on financial risk and the firm's ability to meet debt obligation than executive pay structures. And when you talk about the frequency of board meetings, this affects corporate governance quality, which can influence both shareholders and debenture holders, but it's generally an oversight issue. So it doesn't directly address the specific agency conflict between shareholders and debentures. So the one that can create the risk is option B, which states that the risk profile of the new investment projects. Now, question number 6. Maisha Bora Limited preferred shares pays an annual dividends. Maisha Bora Limited preferred shares pays an annual dividends of 5 shillings full stop. If the required rate of return is 7%, what is the value per share of the preferred share capital of Maisha Bora? Maisha Bora Limited preferred shares pays an annual dividends of 5 shillings. If the required rate of return is 7%, what is the value share of the preferred share capital of Maisha Bora? Now, in terms of calculation, we have been given that annual dividends equals to 5 shillings. Then we have been told the required rate of return equals to 7%. That is 0.07. Now we need to calculate the preferred share capital of Maisha Bora. Now the preferred share value, preferred share value equals to the annual dividends divided by the required rate of return. That which is going to be, we have been told that the annual dividend is 5 shillings, the required rate of return will take 0.07. That will be 5 divided by 0.07. So if we calculate that, 5 divided by 0.07 into 2 decimal places, we are going to get 71.43. 71.43. So our answer is A, 71.43. That is the preferred share capital. That is the preferred share value or preferred share capital. The cost is 71.43. Now, let's move on to question 7. Question 7 is asking, a preference share with a par value of 100 shillings pays an annual dividends of 7.5 shillings. A preference share with a par value of 100 shillings pays an annual dividend of 7.5 shillings and is currently trading at 90 shillings. It's currently trading at 90 shillings. What is the dividend yield of the preference share? What is the different yield of the preference share? We have given our option as 8.33, but how do we get that? Now, the dividend yield equals to annual dividend divided by market price, all into cross brackets, times 100. So we have been given that annual dividend equals to, then of course market price equals to, so from our question we have been told that a preferred share per value of 100 pays an annual dividend of 7.5 shillings. So the annual dividend is of 7.5 shillings. Then we have been told that, and is current trading at 90 shillings. So the market price is 90 shillings at that point. So we have our pays. Let's apply. So the dividend yields equals to 7.50 divided by 90 times 100. So that is going to be, let me calculate that. So that will be 7.5 divided by 90 times 100. That will be 8.3. 8.33 into 2 decimal places. So that becomes our answer. So our answer is 8.33. Now question number 8. A company is considered an investment that will pay 10,000 shillings at the end of the year for the next 5 years. If the required rate of return is 8%, what is the present value of this investment? Now, we have been told that a company is considering an investment that will pay 10,000 at the end of 10,000 shillings at the end of each year for the next 5 years. If the required rate of return is 8%, what is the present value of the investment? So we want to calculate the present value. So we have been given that the annual payment, that is known as PMT, is equals to 10,000 shillings. That is what they're looking forward. The number of years is 5 years. And the required rate of return is equals to 8%, which is same as 0.08. So we have been asked to calculate the present value. Now we will use the formula. The present value equals to the annual payment, that is PMT, times into brackets 1 minus 1 over 1 plus R raised to power the number of years that you're looking for, then you divide by the rate. So that will be equal as, we have our annual payment is 10,000, so that is going to be 10,000 times 1 minus 1 over 1 plus the rate we have said is 0.08. The number of years is 5 years. You close brackets, divide by 0.08. So this is equals to, if we we take, that will be 10,000 times 1 minus, so we take, let's calculate, let's calculate that first. 1 plus 0.08, you get 1.08. You raise it to power, you raise it to 5 years, you will get 1.4693 into 4 decimal places. So that will be 1 divided by 1.4693. You close, divided by 0.08. So that will be 10,000 times, so 1 divided by 1.4693 equals 0.6806 into 4 decimal places divided by 0.8. So that will be 10,000 times 1 minus 0.6806 equals 0.3194 divided by 0.08. Then, so 0.3194 divided by 0.08, you will get, that is 10,000 times 3.9925. So which is equals to, if you take the answer, you times 10,000, you will get 39,925. 39,925. So our nearest answer is 39,927. We have got a 925. I think that comes because of the decimal places that we have taken. So but if you calculate like that, you get the answer 39,925. So that is the right answer. If you're using, it depends on if you're using the calculator, that is the answer you'll get. So the answer will be 39,927. So there's a difference of 2. That difference might have been caused by the aspect of rounding off. Now just a minute. Zero 0.3194 divided by 0.08. Okay. So the 925, that should be the right answer, the exact answer. But in terms of options, we can take the first one, which is nearest, with a difference of 2, which might be caused due to aspect of rounding off. Now if you look at number 9, calculate the future value of 5,000 shillings invested today at an annual interest rate of 6% compounded quarterly for 3 years. Calculate the future value, not the present value, the future value of 5,000 invested today at an annual interest rate of 6% compounded quarterly for 3 years. Now we have been given that the present value equals to 5,000 shillings. Then we have been told the annual interest rate equals to 6%. That can be also like 0.06. Then compounded quarterly, so it means that the interest rate should be divided by 4 because we have been told that it's compounded quarterly. So it will be 0.06 divided by 4. So we'll get, let me do that, 0.06 divided by 4, 0.015. 0.015. In interpretation, this is almost 1.5%. Now, then we are told that the number of years, we have been told that number of years is equals to, we have been told from the question, the number of years is 3 years. We have been given 3 years. And then, of course, the number of compounding. So we get the number of compounding period, number of compounding periods, which is n, which is equals now to 3 years. Of course, they are being compounded quarterly, so that times 4. So we'll get that is 12 quarters. So these are compounding, that is 12 quarters. So for the purpose of calculating future value, we have been told to calculate the future value. What we are going to do, we are going to take the present value times into brackets 1 plus the rate of return, use the total number of compounding periods divided by total number of compounding periods, into brackets raised to power the number of compounding periods that we have present. No, this is this is the present value times into brackets 1 plus the annual rate divided by the number of compounding periods per year, into, you close the brackets, into raised to power the number or the total number of compounding periods. So that is, we have been given the present value is 5,000. So that is 5,000 times into brackets 1 plus, we have gotten the rate which is compounded is 0.015. that is the one that we are going to use. So plus now remember, let me make it clear. Remember, I have said that this aspect here is 1 plus the rate, which we are given our rate to be 6. Our rate we are given to be 6%. So we got our rate at 6%, an annual interest rate, but we say we are going to compound it quarterly. So we divided by 4. So in our future preference calculation is present value times 1 plus the rate divided by the quarterly, which is compounded, raised power to the number of quarterly or compounded periods. So this rate divided by the number of all the compounded number, already we have calculated it. We have calculated 0.06 divided by 4 for us to get the rate of 0.015. So what we'll do here is to take that rate 1 plus 0.015 into brackets raised to power 12. Power 12 is the period, or what we call the compounding periods that we calculated, 3 times 4. So that will be 5,000 times, this is into brackets 1.015 raised to power 12. So that will be 5,000 times, if we calculate that raised to power 12, 1 if we calculate that, that is 1.015 raised to power 12. We will get, that will be 1.1956 into 4 decimal places. So if we calculate that times 5,000, times 5,000, we will get our answer to be 59. Our answer will be 5978.09 into 2 decimal places. 59.78, that is 5,978. 5,978.09. That becomes our answer, or the future of or that is our future value. So the option B, 5,978.09 is the right option. Question number 10. Which one of the following is not a characteristics of short-term source of financing? Now, before you look at the option, when you talk about short-term finance, this refers to the funds borrowed or raised for a period generally less than 1 year. So they are used for the purpose of immediate operations, financial needs within the organization. So these are like working capital that are used for the day-to-day operations within the organization. If you look at the common short-term sources of finances that we have, for example, we have the trade credit. Trade credit, this is whereby suppliers allow businesses to buy goods on credit or maybe services and then pay later. This helps manage inventory without immediate cash outflows at that time. So it improves the cash flow by delaying payments. Another type of short-term financing is the bank overdraft. This is whereby the bank allows you to withdraw more money beyond the current bank balance that you have in your account. So up to an agreed limit that you are given. So it's used to cover short-term cash shortages or unexpected expenses. So which means that if you do not have money, your account balance is 0, but you can still access maybe 200,000 that you can withdraw as an overdraft. It's flexible and it can be used repeatedly up to the limit. So which means that you withdraw today, tomorrow you transact, you deposit money, the overdraft deducts it. Then of course, this is like Fuliza, whereby you have no money in your M-Pesa, but you can send somebody 2,000 if you have that limit. So after sending the 2,000 from Fuliza, once you deposit the money, Fuliza will take its 2,000 plus the interest, then you pay. So you pay, and in fact, immediately you reaccess the loan and stuff like that. So that is about specifically now, that is Fuliza is just an example, but bank overdraft, you are given an overdraft from the bank. Short-term loans. These loans that must be repaid within 1 year. These are loans that must be repaid within 1 year. So they are usually obtained from banks or financial institutions. They are used to finance temporarily working capital needs. Then we have the factoring. The factoring, this is selling accounts receivable or invoices to a third party, which is a factor at a discount. So they provide immediate cash instead. So you are selling your debtors so that you are selling your debts. I mean, you are transferring your debtors to another third party. So your debtors now are likely to pay the third party so that you get the access immediately for the purpose of your financial needs. So they provide immediate cash instead of waiting for customers' payments. So this factor takes responsibility, or the factor takes responsibility for collecting now the debts. Now the debts will not pay you, but they will pay the factor. We have the commercial paper. The commercial paper is a short-term and secured promissory note issued by companies. They are used to raise funds quickly from investors or financial institutions. So they finance short-term liabilities like payroll, inventory, purchases, and all that. And then we have accrued expenses. So these are expenses that have been incurred but not yet been paid, like wages, taxes, and all that. So they allow businesses to manage operational costs temporarily without immediate cash outflows. So they reduce the immediate cash requirement. So when you're being asked with the questions, which one of the following is not a characteristic of short term? Generally needed for up to 1 year in duration, very true. Higher interest rates compared to long-term financing, very true. Requires frequent repayments, exactly. Used primarily for long-term capital investment, that is wrong. So the best alternative answer is D, which states that they are used for long-term capital investment. This is false and not a characteristics of the short-term basis, because we have said short-term is for 1 year. So long-term capital investment like buying machinery, buildings, technology upgrades, and all those, they require long-term financing because these assets provide value over many years. But when you talk about short-term financing, it's unsuitable because the repayment schedule is too short, creating the liquidity risks. But when you look at the other options, like generally needed for up to 1 year duration, this is true because they're short-term financing, which is up to 1 year. High interest rates compared to long-term, yes, because the risk is high, the interest rate is also high. Requires frequent repayments. Of course, you need to pay frequently over a short period so that you can be able to complete your loan in that. So that is up to the first 10 questions, and that is how you answer those 10 questions.